A shady financial tool from the housing bubble era is making a comeback. I can't wait to sink my teeth into this clickbaity CNN article headline.
I keep it real, I keep it real, I keep it real, just keep it real.
Hey, what's up guys? It's Sam Hartman, keeping it real estate here in Fort Wayne, Indiana. And as always, I am here to bring context and clarity to real estate headlines like this one so that you can become a confident consumer when it comes to real estate. Now, I saw this CNN article headline and it just screams clickbait from the jump. But of course I had to click. Being in real estate, I've got to see and know what consumers are reading so that I can bring that context and clarity to the scenario as well and try to overcome those fear and objections that headlines like this really can cause in consumers. Because let's be honest, here's the thing. Most people will see this headline and then not touch the article. They'll see it and they'll bring it up in conversation. Hey, did you hear the housing market is in a bubble again? Heard they're doing some shady stuff with financing. It's all gonna come crashing down. And they say those things by reading a headline, but without any context. So let's dive into this article. Every paragraph of this article just screamed something at me. So I'm gonna literally read the article paragraph by paragraph and add my context to each paragraph and my thoughts to each paragraph. And I wanna get your feedback from this as well. I would love to get your take and your opinions of what you think I'm saying versus what you think the article is saying. But I think articles like this have never proven it's so important who you listen to out there, whose opinion you're taking as more valuable than others, because opinions are like assholes. We all have them and a lot of them stink really bad. So let's dive into the article, see what you guys think. Let's remind you of that headline again. A shady financial tool from the housing bubble era is making a comeback. Shady financial tool, housing bubble coming back, boom, boom, boom. Let's strike fear into the minds of readers and consumers right off the jump. And as we get into this article, you gotta read it with perspective of, is the person trying to sell me something? Are they trying to push me into feeling one way or the other way? And every word that she writes in this article almost feels like it's just trying to strike fear into the reader. So let's jump into the first paragraph. America's gummed up housing market is a $45 trillion mess. A big old knot of economic forces smashing into a century's worth of cultural conditioning about the value of home ownership. So basically she's saying the value of home ownership has just been culturally conditioned. Maybe it's a farce that there's really not value of home ownership there, which I think couldn't be less true. There's an immense amount of value in owning a home financially. The net worth of a homeowner is actually 40 times higher than that of a renter. That's a fact. But there's also tons of non-financial benefits in owning a home. There's the peace of mind knowing that your rent isn't going to go up every year. There's the peace of mind knowing that you can do what you want to your house when you want to do it without having to ask a landlord's permission. And there's the peace of mind that you are coming home, that this is not someone else's home. You can use it as you'd like. You can change it as you'd like, and you don't have the fear that you're going to be pushed out one day by someone that's out of your control. So you tell me, do you value that in home ownership? Do you think that is a century-old farce that is being created? I don't think so. Paragraph 2, there are some obvious urgent needs. We need more housing, full stop. And that housing needs to be affordable. And we should probably stop letting Wall Street firms become landlords for the sole purpose of extracting capital from renters who could otherwise build the equity. So first I want to jump into the Wall Street firms. I've done a video on this recently because it's a common misconception. Wall Street firms actually own less than 1% of the housing stock in the United States. So yes, there are Wall Street firms that are landlords and that own swaths of homes, especially in certain markets. It might be a higher volume than others, but across the United States as a whole, less than 1% is what makes up the inventory of those homes owned by Wall Street firms. So you tell me, is that a critical mass? Is that a large number or not? I don't think so. She goes on to say that the sole purpose of these Wall Street firms as landlords is to extract the capital from renters who could be otherwise building equity. How does a renter build equity by renting a home? Answer: they don't. They build equity by buying a home, by paying their monthly mortgage payment, paying the principal lower, and riding a wave of appreciation into the future. That's how a renter builds equity, is by purchasing the home, not by being a renter, not by paying rent. So her whole premise here is completely off. Slam dunk, gotcha there. The point is, policymakers aren't running out of puzzles to solve when it comes to housing. Perhaps the last thing the market needs is another shady financial product that pushes low-income Americans into homes they can't afford under terms that could bankrupt them. This paragraph sounds really, really scary, but here's what she's missing. She's missing the fact that low-income people aren't buying homes in today's market. And low-income people that can barely afford a home aren't getting pre-approved in this market. The lending standards have increased so drastically from the housing crisis of 2008. The portfolio and the profile of home owners and mortgage borrowers is so high today compared to what it was previously that these people getting these loans are not at high risk of defaulting. They're actually extremely strong borrowers. They just might not have the initial capital funds to put down on the home to make that purchase up front. And so that's what we're talking about today, is we're talking about 0% down home loans and how those are affecting the housing market. And that's the next line of the article. And yet, here we are, the zero down mortgage is making a comeback. And that's what this article is mainly about, is about these 0% down mortgages making a comeback. Now, I want to highlight here, there's always been 0% down mortgage options. A veteran loan is 0% down. A USDA loan is 0% down. An FHA loan and many lender programs have offered 3% down to as low as 1% home loans for FHA loans to purchase. So there's always been these large number of options that home buyers and borrowers could utilize to minimize the amount out of their pocket that they have to put down on a home. I bought my first home on a USDA mortgage up in Angola, Indiana. It was a $75,000 home. I actually got a check at the closing for $1,400 because of the credits and seller concessions I was getting as part of the sale. So I actually bought a home and made money. And not only did I make it then, I made it every month when I rented out those bedrooms to friends of mine. And then I made money again when I sold the home. So again, I built equity as a homeowner, not as a renter. Continuing with the article, zero down, but lots on the line. Let's briefly get into how it works. And then we can talk about why it's a huge red flag for anyone with passing understanding of the 2008 financial crisis. I'm going to stop here and I'm going to argue that she doesn't have a passing understanding of the 2008 financial crisis. But we'll continue. So you want to buy a home, but you're not sitting on enough savings for a down payment. Super common and totally fine. We've all been there. Under the deal being peddled by United Wholesale Mortgage, you can bypass that initial cash payment. Sounds great, right? Instead, you borrow 3% of the home's value, up to $15,000, as an interest-free loan and pay for the 97% of the home's value with a standard mortgage. So basically, you're getting the 3% down payment as a separate secondary loan on the home. Now, this is a loan, so it will need paid back one day. This isn't free money. This isn't government money. This is money that you're borrowing, but you're borrowing it at 0% interest. That's a phenomenal deal. She goes on. Here's the catch. That $15,000 won't accrue interest, but it will need to be paid back. Oh my God, a loan that needs to be paid back? They're tricking me. They're swindling me into being foreclosed on, into taking a financial risk I should never have, I never even knew about. Idiots. The $15,000 will need paid back in full all at once when you either sell the home pay off the mortgage, or refinance the home. That will work out great, assuming nothing bad happens to you or the economy and the value of your home keeps going. And honestly, when has the value of housing market ever gone anywhere but up, up, up? All right, we can hear the sarcasm. Let's go on. So let's highlight some of the ways this $15,000 sword of Damocles could wind up stabbing you in the back. Again, this is where I forewarn. How is someone writing an article? What did they want to make you feel as part of reading this article? And her language, every paragraph of the way, is so damning, so dark, so negative. No positivity, no possible other side of the coin to consider when looking at this data. She just wants to shit all over it. So here's number one, how it could stab you in the back. The housing market, as we all remember from The Big Short, great movie by the way, does not always go up. And because you didn't put money down, you'd be instantly underwater, owing more than the home is worth if the market sours. She calls out The Big Short movie, and I think this is a phenomenal point to bring up. Because if you watch that movie and if you understand what happened then, it seems like every other person in the world right now is calling for a housing crash and has been calling for it for the last 5 years. But in 2008 and The Big Short movie, there was only one person that saw it coming. There was only one person that looked deep enough into things to really have this expert insight to potentially project that this might be happening. And yet here we are today, every other person in the world is an expert calling for a housing market crash. I think they might be missing something. I think it might be a little bit more difficult to project and to claim than just that. But I love that movie. Don't love what happened. Don't love that it's a true story. It was dark times for a lot of people, but a lot of good things did come out of it for the housing market, and that's what we're talking about today. She also talks about being underwater on your home, and this is true. If home prices aren't going up and your home is now worth less than what you owe on the mortgage, your home is considered underwater, which means it makes it difficult to sell because you would either be negotiating a short sale with your bank or you'd be actually bringing money to the table to sell your house because you don't have that equity. But here's where she's wrong. People don't sell their house when they're underwater. And it doesn't matter if someone's underwater on their house as long as they're employed and able to make their mortgage payments. And that is the profile of homeowners that we're looking at in today's market. Is the strength of the borrower is so strong. Their employment, their income, their salaries, their debt to income ratio is so strong that there is low risk compared to the 2008 housing crisis. So even if a home borrower is underwater on their mortgage, and there are certain markets right now where this is becoming a little bit more common, the fact that the economy is strong, the job market is strong, wages are strong right now, means that they're going to continue paying on their home. And as home prices continue to rebound in those markets, they're going to be fine. You don't want to be underwater when tragedy strikes. Losing a job or falling into financial distress might prompt you to try and sell your house, which would put you on the hook to pay back that $15,000. But if the house isn't worth what you owe, you'll be in default. The scenario is exactly what happened during the subprime crisis, said Patricia McCoy, a professor at Boston College Law School. It happened before and it could happen again. I got to assume a Boston College law professor is smarter than me, but it seems like a pretty drastic stance to take that is exactly what happened in 2008 and comparing it to this loan product today. The loan products in 2008 were substantially different than the loan products of today. The borrower profile of 2008 was substantially different than it is today. So I'm sorry, Patricia McCoy, professor of law at Boston College, but I think you're wrong. I think that's a drastic statement to make. I think that's extremely short-sighted and one-sided without taking any potential context or other information into consideration. Let's go on to the third way that this new loan product can stab you in the back. Even under the rosiest economic scenario, you still have to pony up the $15,000 at some point. And as any homeowner can attest, your house is going to be a constant financial drain from the moment you're handed the keys. You are going to have projects, lots and lots of projects, and they won't always be the fun DIY bathroom renos you see on TikTok. Most of them will be the, holy, we have to replace the entire roof before the winter kind of projects. And that's going to slow your cash accumulation significantly. Well, I do love your creative writing, but I hate your tone and I hate your negativity. I like to bring positivity to the world, so don't be negative, don't drag people down. Let's brighten up people's day, let's be positive, and let's look at the brighter side of the street here. So yes, you're gonna have to pay back that $15,000 if and when you refinance your home and if and when you go to sell your home. But I think she's being extremely short-sighted in terms of considering the lots and lots and lots of projects. You don't have to buy a home that is in disarray. You don't have to buy a home that needs a new roof or new windows. I just walked a home yesterday with a client, and as we were walking through, as soon as we walked up, I said, that roof is old. I looked into it, determined it was about a 28-year-old roof, which means it's gonna need done. So my clients knew going into this house, whether they would like it with those upcoming expenses or whether they wouldn't want it because of those upcoming expenses. Or if they did like it, guess what? We could negotiate those terms with a seller in the purchase price, in a seller credit, and on the inspection. So there are lots of ways and protections when you work with an expert realtor, a local expert who's there to advise you as a buyer that can help protect you. I also walked that house, and as we were walking the house, I like to crank open windows, especially when it's a 30-year-old house with older wood windows, and lots of the windows were defective and had rotting wood. Now, I'm not an inspector, but I know how to kick the tires on a house. So we went into that house, eyes wide open. It's gonna need a roof, 20 to 30 grand for a roof. It's gonna need new windows. 30 to 50 grand for windows. I mean, it could vary widely depending on the grade of windows you do. But my clients had this information during the walkthrough so that they can make an educated decision. That's what buying a home is like. That's what buying a home is about. So she's being very short-sighted, very thinking that consumers are uneducated and uninformed about the process. But guess what? If you work with an expert realtor, you're not going to be uneducated. You're not going to be uninformed. You're going to walk homes eyes wide open as to the potential costs that you'll have out of pocket and to the expenses that you may have in the future as a homeowner. And you can make your decision of whether to buy that home or not for yourself. The article goes on a little bit longer, but I think I made my point. Pretty much every negative comment she had to make, I had a data-driven point and counterpoint to make to her. Every negative kind of snide thing she had to say. She might be a more creative writer than I am, and she did a great job accomplishing what she wanted to do in terms of striking fear and confusion into the readers. But I hope I brought some context and clarity to the other side of the coin, the other way of looking at things, looking deeper into data-driven points as opposed to emotionally driven points, which I think she clearly is writing on emotion here. So that's it. I loved diving into this. This made my blood boil when I read it the first time, but the more I read, the more I realized how I could be helpful in providing context and clarity on articles like this to my consumers and my customers out there. I hope you found this information valuable and helpful. If you did, make sure you like and subscribe to my channel so that you get to see the next great video I put out that covers bullshit like this. And if you think someone else could benefit from this information, share this with them. And hey, guess what? If this isn't doing enough to cover all the topics for housing questions that you have, reach out. If you're in Indiana, if you're in the Fort Wayne, Indiana market, I am here to help answer your questions and advise you through the home buying and home selling process. All of my consultations don't always result in someone buying a house. They don't always result in someone selling a house. But I'm here to provide the context and information that you need to be confident and make an informed, confident decision. And that's what I want to do for you. Thanks for keeping it real estate with me, guys. We'll see you next time.
I keep it real, just keep it real.